This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
When the going gets tough, the tough get to strategizing. When the markets turn scary, there are things that you can do to help yourself both now and into the future. So that's what we're going to call today's topic for today's Wise Investor Show podcast, the Scary Market Survival Guide. Hello and welcome to the Saturday, March 29th edition of the Wise Investor Show. My name is Greg Smith, certified financial planner, practitioner, and head financial planner with the 17-person Wise Investor Group, and I am delighted to be here with you again. When things turn scary in the world of investing, as they have been since the beginning of this year, it's important to recognize the things that you can do during the scary times that will benefit not only you, but the you of the future as well. You need to take both into account. You're not without strategy and choice when investing gets challenging. So for today's show, I'm going to spend our time together offering you some tips and tricks that we all have up our sleeves to call upon whenever things do get scary in the stock market or we feel like we're not in control when it comes to investing. And I get it. Investors are feeling a little on edge and are concerned and rattled by how the markets have behaved so far this year. There's much uncertainty. There are many stressors entering into the psyche of investors at the moment. The Magnificent Seven has turned into more like the Moribund Seven, at least so far this year anyway, and we're a little out of practice when it comes to seeing markets decline. The last 2 years, 2024 and 2023, were pretty good years to be investors, as were 2021, 2020, and 2019. 5 out of the last 7 years have been favorable for investors. But with this year being negative so far year to date, which of course doesn't mean necessarily that it's going to wind up being a negative year, please keep that in mind. But with this year being negative so far, that puts us at 2 out of the last 7 years being scary. What does that mean? Well, it means that negative or scary years are in the minority, and the majority of the time investors make money investing. As a matter of fact, in looking at the last 96 years of investing, the S&P 500, for example, was positive 65 out of the last 96 years and negative 31 out of the last 96 years since 1928. That breaks down to almost exactly 2/3 of the time that the market is going up, and 1/3 of the time it winds up being negative. Therefore, if 2/3 of the last 96 years of investing are positive, then most of the time the market makes advances, while the minority of the time, 1/3 of the time, the market loses value, investors lose money. But once again, the majority of the time, markets make advances, and investors typically make money investing. So I think that knowing that history is on your side. I think knowing that is important. It's also important to remember that the stock market does pull back regularly. You may or may not notice it all the time, but the market pulls back 5% on average about once every year. The market pulls back 10% on average about once every 2.5 years. So we've really been due for this year's pullback. The market pulls back 15% or more about once every 5 years. And the market pulls back 20% or more on average about once every 6 years. So scary times are part of our investment history, and they're going to be, like it or not, part of our investing future. So get ready. If you've got a long time horizon in front of you, then you're looking at significant pullbacks along the way. I don't know how big a pullback this year's decline will be, or if it will wind up positive or negative for the year, but I thought that in the event you're scared or worried about investing or your portfolio, that this would be a good podcast at this time to share with you. Now, all that being said, please recognize that past performance is no indication of future results, and we can't manage your investments from a podcast, so please consult with your own tax, legal, and/or financial advisor before implementing any of the ideas that I happen to talk about today. And if you do have any questions about anything I cover, then please do feel free to reach out to me anytime at gregory.s.smith@raymondjames.com, and I'll be sure to get back to you right away. So with this year starting off on the scary side of the investment street, I thought it would be good to provide you with a refresher on what it is you can do about it. What are some of the strategies that you might consider that are firmly under your control that might help you make a little bit of lemonade out of the lemons that the market sometimes gives us? The first thing is to take stock, no pun intended, on where you are from a cash perspective. If you have a 6 to 12 month supply of cash on hand, then you're in a strong position as it is. With an ample supply of cash on hand, you do not have to be a forced seller. Financial planners love to see their clients have a 6 to 12 month supply of cash on hand. 6 months worth of cash if you're still working, and enough to cover 12 months of your day-to-day living expenses if you've already retired. Well, why is that? It's because having that supply of cash on hand buys you time. It helps you weather market storms. It makes you worry less about the gyrations of the market when you have the cash on hand that you need in order to keep the lights on and pay the bills. And finally, we're getting some interest on the cash that we're sitting on, which really hadn't been the case up until a couple of years ago or so. And when it comes to cash, I'm talking about checking, savings, money market, CDs, cash value of life insurance, savings bonds, and generally readily available money that does not go down in value. So if you're in the position where you hold an ample supply of cash on hand, you can sleep a little bit easier during scary market times, knowing that you can wait out market storms until more favorable winds prevail. So that's step one. Make sure that you're where you want to be from a cash perspective. It's during these difficult and challenging times that cash supplies that you carry could really come in handy. And it's one of those things where you want to make sure that you have it at all times because you never know when the challenging times in the market happens to be coming. The next thing that you can do is assess your asset allocation. In your portfolio, what is your mix, percentage-wise, of stocks to bonds to cash? This is something that is indicative of how much participation in the upside and the downside you'll experience no matter what the markets happen to be doing. So you're going to want to make sure that your asset allocation puts you in the position to achieve your financial goals and objectives within the context of your financial plan. And also, at the same time, you're going to want your asset allocation percentages that allow you to sleep well at night, even when the markets get scary. And as we know, and as Yoda might say, get scary, the markets invariably will. And as I mentioned earlier, over the last 96 years, according to macro trends, the market, in this case the S&P 500, for example, pulled back almost precisely 1/3 of all the calendar years dating back to 1928. So it's always something to be prepared for. The good news, though, is that the inverse is also true, that 2 out of every 3 years on average, the market makes advances, which then tends to more than make up for that one bad year on average. That's where investing is so much different from gambling. With gambling, the odds favor the house. Every single game, every single day, even the casino game with the best odds in the house for the gambler, still favors the house, which means that ultimately and statistically, that when you're gambling, the longer you sit at the tables in Las Vegas, the more you're going to lose. The opposite is true when it comes to investing. Since 2 out of every 3 years on average are beneficial to the investor, the longer you're able to stay invested, statistically speaking, the more you're going to win over time. Therefore, one of the main reasons for making sure that you have the right amount of cash on hand and the proper asset allocation is so that you can have the exposure to the equity markets that you need in order to accomplish your goals, but not so much that it gets so scary when times get tough that you're moved or scared enough to upend what you're doing and abandon your strategy out of fear. With both an ample supply of cash on hand as well as the proper asset allocation, the percentage mix of stocks to bonds to cash. These are two of the most important preventative measures you can take to protect yourself when markets get scary. Another important preventative measure you can take is to make sure that your financial plan properly reflects your financial goals and objectives. In other words, your financial plan shows the path to getting what it is that you want. You want to make sure that your financial plan is current and up to date, and if it is, then all you need to do is remember that you set up this plan when everyone was calm and sanguine, and everyone had the presence of mind to look long term. When things get scary in investing, we tend to devalue our financial plan, no longer looking long term, and start to focus solely on the present. If you have a financial plan, you can do yourself a favor by thinking of your financial plan as a lifeboat. When the seas get rocky, we don't jump out of our lifeboat. We stay firmly planted in our lifeboat. Your financial plan is your lifeboat, and I want you to remember that at all times. Stay comfortably seated in your lifeboat, as that is what will get you through the storm, especially when the sea gets angry, my friends, as George Costanza might say. All right, so let's say that you have your 6 to 12 month supply of cash on hand. You have the proper asset allocation that comports with your risk tolerance. You have the financial plan in place, and you recognize that it's your lifeboat, and you don't abandon your lifeboat, and things are still scary for you. Then what do? Well, stick around after this brief word, and when I come back, I'm going to have even more challenging market survival tips for you when I come back. You're listening to Greg Smith, Senior Financial Planner with the Wise Investor Group, and I'll be right back. Stay with me.
Have the Magnificent Seven become the Lagnificent Seven? The clear leaders of the past 2 years are now bringing up the rear. Is this just a correction or something more? Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about these investment trends and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Thank you, and welcome back to the Saturday, March 29th edition of the Wise Investor Show podcast. I'm Greg Smith, Senior Financial Planner with the Wise Investor Group, and today I'm sharing what I hope will be useful tips and strategies you can employ whenever markets get scary and bumpy. And let's face it, 10% corrections are no fun to experience, and we just experienced it a couple of weeks ago when the market declined a little over 10% on March 13th from its mid-February high. There continues to be a lot of uncertainty and stressors in the market, so I thought that this was a timely topic for us all. When things get scary in investing or for your portfolio, my next idea is for you to take a deep breath and focus on where you have control versus where you do not have control. And it's important to realize where you do have some controls and levers that you can push and pull. Unfortunately, within financial plans, there are a lot of areas that are just simply outside our control. We can't control tax rates. We can't control inflation. We can't control how long we live or the price of gasoline or electricity. We can't control what the stock market does, what the bond market does, what the Fed does. There is a ton that is outside of our control. But we still do have a couple of aces up our sleeve if we needed or wanted to make use of them. What we do have some modicum of control over is A, how much we spend, and B, if we're still working and wanting to work, how long we work is another control. So when you feel like you might want to do something when the markets get scary, if you have the right amount of cash on hand, you have the right and proper asset allocation in place for you, your financial plan is current, reflecting your goals and objectives, you're sticking to your plan, then it's a natural thought to be seeking to make use of the controls that you do have, such as contemplating how long you work, and if it feels better during scarier times, how much you spend. For clients of the Wise Investor Group, we typically update financial plans at least annually, and in a good solid financial plan, we have a spending target, how much it takes to keep the lights on and do what you want and need to be doing. Well, we set that number annually, and so having the financial plan in place to indicate how much is spendable over the next year until we meet again can really smooth out even the scary times and keep our focus on the long term. And then, in addition to knowing where we have controls, where we don't have controls, if things are scary in the market and perhaps you have some losses in your portfolio, in your taxable account, you can do something beneficial for yourself and your family, especially come tax time. You can harvest losses. Capture those losses to offset gains that you might have later on in the year or when they present themselves later on. You can sell something at a loss and purchase something else that's really close to being the same investment, though it can't be identical, and bank that loss. That's what's referred to as a tax loss swap. You sell your existing investment at a loss, you buy something else that's very similar, perhaps in the same sector or a similar type of company or investment, and that way you've banked the loss, but yet you're still participating in that sector or virtually that same investment. And you can deduct then up to $3,000 worth of losses above the line from your income and then carry forward any additional losses into future years in the form of a bank of losses that you can draw from later. Having that bank of losses can be helpful and provide breaks on gains in the future that you might have. Losses are indeed our friends, and I would encourage you to make a little lemonade by taking advantage of tax loss swaps when the market is already making us pucker, as it were. And last, tax loss swaps don't work in IRA accounts, but I do have another idea for you, which is if you want, and if you have an investment in your IRA account that is way down, and you think it's being unfairly punished by the market, and you have a strong long-term thesis on that investment, something that you can do is consider converting some or all of it to your Roth IRA. That's where you take the security itself that's in your traditional IRA, you convert it over to your Roth IRA, and you do pay the taxes on the total amount that you convert. The idea here is that you're paying taxes on an investment that you think is undervalued, and then you let it recover within the friendly confines of a tax-free environment, and you will have done it when you thought it was being unfairly punished by the market. It's an aggressive maneuver since you'd be paying taxes on that investment earlier than you otherwise would have had to. But if you have strong conviction in that investment that's being pummeled by the market, and you'd like to potentially take advantage of what you might perceive as an overcorrection by the market, you do have that Roth IRA conversion idea in your hip pocket as an idea for what to do with securities that you think may be undervalued by the rest of the market. Just bear in mind that once you make that conversion, you're committed. You're committed to it. There used to be a mulligan that you could take on that conversion where you could put it back as though you never converted it in the first place, but that mulligan has been gone for years. So once again, before you implement any of this, make sure you speak with your tax and financial advisor before implementing. And there you have it. When things get scary in the investment world, as they invariably will, you are not without options. I've provided in this podcast tips and strategies to help you remain as emotionless as possible and remain in control. By making sure that you have the right amount of cash on hand to weather market volatility, by making sure you have the right asset allocation to meet the goals of your plan and make sure that you're able to sleep at night. And remembering that your financial plan is your lifeboat, and we stay in our lifeboats, especially when the waters become choppy, then you're going to be just fine. And further, if we recognize that market pullbacks are naturally occurring, they're very common, just learn to expect them, realize it's all part of the deal when it comes to investing, then it makes it easier to cope with the temporary moments of fear. And as we look through history, these moments of fear really do remain temporary. And lastly, if you wanted to be even more proactive about taking advantage of volatility when the opportunity presents itself, then taking advantage of tax loss swaps, locking in those losses while still participating in a similar security, and also Roth IRA conversions of positions that you think will recover well only inside then a tax-free account rather than your tax-deferred account are all ideas for you to consider. And I hope that all this has been really helpful for you. It was a lot of fun to put it together, and if you have any questions about anything I've covered on today's Wise Investor Show podcast, please reach out to me anytime at gregory.s.smith@raymondjames.com, and I will be sure to respond. Simon's going to be hosting next week's Wise Investor Show podcast, and until then, this is Greg Smith, Senior Financial Planner with the Wise Investor Group, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.